Good evening, everyone. Welcome to today's live webinar on issues and transfer of shares under the Companies Act 2013 Practical Insights. We are delighted to have all of you with us today for this focused session. It is my pleasure to extend a warm welcome to our Chairman, Sir C.A. Babu Ibrahim, in absentia, our Vice Chairperson, C.A. Preeti Savla Madam, and today's esteemed speaker, C.A. Gopal Krishna Raju, and our moderator, C.A. Rupal Haria. We're honored to have all of you with us today. I would now request our Chairman, sir, to kindly address the participants and formally open the session.
Good evening to all of you. At the outset, let me wish you all a very happy and prosperous new year and year of new beginning, new learning, new resolutions, and take the profession and the institute forward to a next level. I'm extremely glad and delighted that my former colleague in the regional council in the south, CA Gopalakrishna Raju, is a distinguished speaker of the day, and he has agreed to discuss on one of the very important topic issues and transfer of shares under the Companies Act. I think all of this is one of the most practical topic. That may be the reason that good number of participants have joined across the country. I'm extremely delighted that the topic and the speaker has attracted the participation. I have no doubt in saying that. And we have started a webinar series on all Fridays between 6 to 8. Next Friday also, please wait for our next Friday webinar. This webinar series will continue, and we will discuss topics of contemporary relevance. And we are also glad that MCA has replaced the annual DAR3 KYC requirement with a simplified KYC intimation once in every 3 years only, effective from March 31, 2026. The revised framework also permit update activation, thereby reducing repetitive compliance burden. In fact, we have been in continuous dialogue with the Ministry of Corporate Affairs. In fact, today our Honorable President and Vice President are having a meeting with the Secretary MCA and discuss on various important matters of. We have regular and we have also have three helplines, our dedicated helplines operated by the Institute of Chartered Accountants of India under the CLCGC to help you to address all your difficulties in filing of the various forms. And another development is that the 2025 amendment clarifies that government companies and their subsidiaries, the indemnity bond for voluntary strike-off shall be furnished by an authorized government representative and not by government nominated directors personally, thereby facilitating procedural constraints. As all of us know, government nominees are many a time hesitant to give such kind of indemnity bond because they are serving as official representatives only. And tomorrow something goes wrong, even after their retirement, it can be a big challenge for them. Therefore, there was now we have also taken up these matters with the MCA, and we are very glad that MCA is also over the years been very proactive in seeking our suggestions and also aligning with our suggestions. And even Companies Amendment Bill 2025 is also in the pipeline, and where we are in constant dialogue with the ministry. With that, I'm extremely glad and delighted to welcome you all for this webinar. Thank you. Over to the moderator.
Thank you,
Yeah,
sir. Thank you so much for setting the context and giving a meaningful direction to this webinar. I would now request our moderator, C.A. Rupal Haria, to introduce our speaker and take the session forward.
yeah. Thank you, Chairman sir, and for your insight. And as we are heading towards the first webinar of 2026, and with the powerful speaker and the topic also itself, as sir has already explained, that the issue of transfer of share is not merely a procedural matter, but it's a core government function requiring accuracy, regulatory discipline, and professional judgment to protect companies from legal, regulatory, and loss of stakeholders' confidence. Now, for me, it is a matter of privilege and honor to introduce our today's eminent speaker, CA Gopal Krishna Raju, fondly and respectfully known as GKR Sir, a stalwart of profession and distinguished thought leader from Chennai. Sir is practicing chartered accountant, registered insolvency professional, registered valuer under IBBI and the Income Tax Act. Sir is coming from renowned chartered accountant family, and it has rendered, as Babu sir has also rightly said, 9 years of services as a member of Southern Indian Regional Council of ICAI from 2010 to 2019. He has been conferred an honorary doctorate in governance of GST in government sector by St. Mother Teresa University, Melbourne, Australia. I'm just taking 1 or 2 minutes more because I can't resist myself for saying about Sir. Sir is distinction qualified independent director, empaneled with Indian Institute of Corporate Affairs. He also serves as a profession as a technical reviewer board with the quality reviewer board constituted by Government of India. Former visiting faculty at IIM Raipur and IICA. So, Sir brings with him wisdom, unmatched practical wisdom for today's topic issue and transfer of shares under the Companies Act 2013 practical insights. So, all professional members, we are truly privileged to learn from professional who seamlessly blends law, practice, and real world application. So, please join me in extending a warm and enthusiastic welcome to CA Gopal Krishna Raju sir. Sir, over to you. Thank you, everyone.
Yeah. Very good evening, friends. At the outset, let me thank ICAI for this wonderful opportunity, especially Chairman of Corporate Law and Corporate Governance Committee, CA Babu Abraham Kallivalji, for reposing confidence in this particular topic. I can do the justice for this. Friends, I'll also place on record the support extended by the moderator, CA Rupal Dhiran, and support from the Secretariat of the committee. This topic is very close to my heart and a very practical one. Day in and day out, we are dealing with issue of shares and transfer of shares, especially with respect to an unlisted company. This entire subject is a mammoth subject and covering various parts of the corporate law. I will restrict my discussion, but of course, the questions can overflow beyond the corporate law, because a subject like issue of shares and the transfer of shares will start from Companies Act, will also go to Security Contract Regulation Act, also may spill over to the SEBI ICDR and LODR regulations for a listed company. It can also go beyond corporate law with respect to the accounting part of it, because with respect to the disclosures on the issue of shares during a period at the close of the year, and also the transfer of shares, the documentation required. Maybe the transfer of shares is not much regulated with respect to corporate law, but in the register of members, the transfer has to be recorded. So to that extent, the law is specific, but before the transfer, it is recorded in the register. There are certain procedure, especially the transfer documents, share transfer deeds. Most importantly, the stamping of share transfer, which generally people forget. Of course, If the share transfer deed is itself in a stamp paper, it is stamped, but whether it is duly stamped, adequately stamped, all this will make a particular transfer valid or invalid. So we will go through all these. I'll try to share some of the case laws, maybe decisions with respect to all this, and also take you through relevant, because there is one more aspect which the other dimension for the issue and the transfer will be the FEMA, the Foreign Exchange Management Laws. So it is, and also the other part will be the valuation part. So whenever you issue a share, not at the beginning, but during the period of that, during the course of the time, the valuation also will take an important center stage. So it is, so this subject is multidisciplinary. So I will try to touch upon all these areas, and I will not be too academic in sharing my thoughts, but I'll try to connect the dots and bring before you, present before you, the various issues with respect to this, how we have to deal with it. So the academic part, I'm sure our professionals will take care of it. But with respect to the practical part, I'll try to make it as practical and simple as possible. Let me first start with one important aspect for our discussion. This is the coverage I'll be doing in this maybe 120 minutes. We'll try to break into 60 minutes to maximum 70 minutes or 75 minutes of discussion, presentation of various aspects. And also, I'll try to share some practical relevant aspects. And then we'll reserve at least 15 minutes or half an hour maximum for Q&A. And during the session also, you are welcome to put forth your queries, and I will address. So when you put your queries, please mention your name and the location from where you are asking those queries. So I'll try to answer as much as possible within that time. So I will devote maximum time for Q&A. And if possible, we can unmute our participants. If possible, they can share their views. Else, through the question, we'll try to answer the same. Now, as I mentioned that this is a multidisciplinary topic, I will try to go as much as possible and again come back to the main land, which is the Companies Act. So I will be going to the various discipline, the relevant part, and come back to Companies Act to give you thrust from the main subject. First, let me take you to a very important aspect called private placement versus preferential allotment. So this is one we will always have a doubt. So what is a placement offer, okay, and what is a preferential offer, okay? So the placement offer and the preferential offer, there is a slight difference. The main difference I'll try to share. Maybe I'll try to catch up the difference in a small pointers. I'll just share it with you. The first point which I want to share is this private placement is like a bigger umbrella, and your preferential allotment is one segment or one part of that umbrella, and it is generally for securities. Of course, preferential allotment is also for securities, but most focused is towards equity and also convertibles. So that is also equity. So, and there also you will be having a specific set of investors. Here also you will have a specific set of investors. Now, most importantly, the number matters because here you will give an offer come an application. So here it is only an offer and direct allotment. So that is where the fundamental difference is. And maybe to give a very, very brief thing, I already made that point that your private placement is a bigger canvas, and your preferential allotment is a specific one within that umbrella. Maybe I'll take an example to give you an idea, especially 62 under section 62 1C of the Income Tax Act, I mean the Companies Act. They specify about the preferential allotment part. Especially, we will be focusing on the equity shares and also convertibles into equity. Mostly convertibles means preference shares convertible to equity shares. So it is fully convertible preference shares or partly convertible preference shares. So convertible to equity will come under preferential allotment. But here, the private placement is not only equity and convertibles, it also deals with other securities also. It can be even the debt instruments. So therefore, it's quite, yeah, and there will be an offer letter come, a process and application form. So that is a quite distinct one, and your section is also separate. It's 42. Okay, and this is 62 1C read with 42. So that means 42 is your bigger umbrella. 62 1C is a specific vertical within that bigger umbrella. So that is one distinction which I want to start with first, especially for private placement versus the preferential allotment. I will now directly go for the 62 section. I'll give you the fundamental aspects, the distinction with respect to 62, and I'll go into maybe the secretarial part I will not discuss. So you have to call for a board meeting, the general meeting, get the approval, the process. So secretarial part I will not discuss. Compliance part I will not discuss. But the issues with respect to these aspects I'll try to cover one by one. Okay. So permit me to take you through some major aspects, especially certain cases with respect to all this. So one by one, I'll try to cover this. So let me first take you to, especially with respect to so this is one part I want to make it clear that issue of shares, transfer of shares. In issue, there will be an allotment and there will be a process you have to follow. And in transfer of shares, there is no allotment. Already allotment is done under the Companies Act. So there is only a process of transfer between the present shareholder or the existing shareholder to the proposed shareholder. So the seller shareholder to the buyer shareholder. So that transaction, which is off the balance sheet. So technically there is no cash flow as far as transfer is concerned, but there are implications because if the transfer is done, okay, maybe one-sided, the transfer is a fraudulent transfer and documents are fraudulent, then the company is responsible. So to that extent, maybe I'll try to focus on few aspects. But today, slowly we are moving from the physical shares to the digital arena. But still we are at the nascent stage with respect to private limited companies and unlisted companies. So therefore, I'll try to focus on those aspects also. Okay. And these are the laws which will be applicable with respect to issue of securities. In addition to the Companies Act, the Securities Contract Regulation Act and the relevant rules. And if it is a listed company, you have the respective SEBI regulations. Maybe you have ICDR, the issue of capital and disclosure requirement, and post issue, the LODR. So both are applicable with respect to issue and transfer. So maybe if the time permits, I'll try to focus on the listed companies area, but predominantly, fundamentally, the Companies Act is a law which is equally applicable for both the listed as well as unlisted companies. So I'll try to make it as practical as possible by taking you through the various aspects. Now I want to bring before you one aspect, which is the private placement and the preferential offer, because this both the terms are defined. So I repeat, both the terms are defined. So you have the private placement is defined in section 42 explanation, and the preferential offer is being explained. So I will not say defined, but is explained. So your private placement is explained in 42, section 42, and your preferential offer is explained in rule 13 of the company's share capital and debenture rules. So that aspect also I will come when I go for section 62 part, because section 62 deals with especially 62(1)(c), because 62(1)(a) is for right issue, 62(1)(b) is for your ESOP, and 62(1)(c) is for your preferential allotment. But please look at the private placement part. So private placement is any offer or invitation to subscribe. Okay. So there is an offer, invitation to subscribe, or issue of securities. The word is securities. So actually, even the section will speak about securities, but with specific to, if you go to 62, subsection C, I mean subclass C, there they have restricted the application only to equity share capital. So because 62 itself is further issue of capital. So there the restriction is only for equity shares and any convertibles. Because today nowadays people want to go for capital, but present valuation will not suffice the because the allotment percentage of dilution will be huge. Okay, so when the valuation is low and you invite the private investors to invest in your company, the dilution percentage will be heavy. So therefore, the investors will not be allotted shares today, but they will be converted. So either a preference shares will be given now and it will be converted to equity later, or a debenture which will be converted to equity later. So maybe we can call it as FCD, fully convertible debenture, or OCD, optionally convertible debenture. So we have the same concept in preference shares. So fully converted preference shares, or we have ORCPS, optionally redeemable and convertible preference shares. So that's all. These are all very common nowadays, both ORCPS and OCD. So this ORCPS is optionally redeemable, or convertible preferential. So that option of redeemable or convertible is with the either with the company, that is the issuing company, either with the issuer. Generally, it is not given to the holder, instrument holder. It is only given to the issuer. So thereby, after 2 years or after 3 years, the allotment will be made. Now, the interesting part is the valuation part. So, at the time of issue of the instrument itself, so I'll come to those aspects also. So, whether you will do the valuation today or you will do the valuation 3 years later. So, the law is very clear that whenever you are issuing, so 60 to 1C, I will read the provisions, I'll tell you. So very clearly, they have mentioned that the valuation which you will be allotting equity maybe 2 years later, 3 years later. For example, 3 years later, you want to allot the equity. So at what price you will allot? So that you have to determine today. So many aspects are made very clear. So reading the law in between the lines, understanding the process is very, very important, especially while drafting the respective agreements. Okay, so private placement is a open thing, and it's big. So that means your preferential allotment is also private placement. So all private placements are not preferential allotment, but all preferential allotments are private placements. So maybe this can give you more clarity. Okay. So as invitation, it's issue of securities to select group of persons through private placement, offer cum application. This offer cum application is also new. Securities. So what makes it distinction is securities and offer cum application, which satisfies the conditions. Okay. So this is where the fundamental distinction is. So I'll also take you to one more aspect here, which is called the securities part. Okay, so I'll bring to your attention the SCRA. Okay, so since we are discussing about the word called securities, okay, I'm taking you to the SCRA Act, Securities Contract Regulation Act 1956. Maybe you have the Old Companies Act is also 1956. Okay, so we can treat that as younger brother or Judwa Bai, okay, of the Companies Act. So here the definition of securities are given at length. So if you look at it, it is 2H. Okay, 2H include. So it is 1A, okay, 1B, 1C, 1D, 2, 2A, 3. My God. So look at the big list. So even the right in securities, interest in securities. So that's where you have a rights, you can renounce it. So that is also a security. So you are an equity shareholder. You have a right to apply for right issue. So that right also can be renounced for a particular price, for a value. Okay. So that is also a security. Okay. So that also can be renounced through an instrument, through a document. Okay. So now please look at this part. It starts with shares. Okay. Stock, bonds, debentures. Okay. Other marketable securities are like nature. So it's such a wide, okay, terminology. So that's why it's a bigger umbrella. Okay. So your private placement is a bigger umbrella. Okay. So now let me take you to certain interesting aspects with respect to the practical part of it. Now I'll bring your attention to this interesting part here, especially whenever there is an issue of shares which is at a premium, that too for consideration other than cash, because it's generally if it is shares are issued at premium, so the premium part will be at the securities premium. Okay, if it is for cash. Now, what if it is for consideration other than cash? Okay, I'll come for that particular part because consideration other than cash, how it will come inside. So especially I'll take you to, after this, I'll take you to issue of sweat equity. Okay, especially the definitions part of it and the issue part of it. So quite tricky. Okay, and that is one particular section which permits to issue shares at discount. Okay, so that is the only security which you can issue at discount. That means equity cannot be issued at discount, but sweat can be issued at discount. So which is very unique. Okay, so now please come to this part where a company issues shares at a premium, even though the consideration may be other than cash. Some equal to amount or value of the premium must be transferred to securities premium account. So your accounting part is made very clear here. So by various decisions, so very old decisions. Okay. I'll now come to these two part here, especially issue of shares at discount. Okay. So it is, so that means if you are at face value 10 rupees, face value 100 rupees. So issue can only be at par or above par. Okay. So there is a word called, actually they should use a word called value, but the entire Companies Act and the rules doesn't use the word called value. It only use a word called price, especially the rule part of it. The company's share capital and debenture rules speak only about a term called price. It doesn't speak about value. The price means price at which you issue. Okay, so they are very clear that the shares cannot be issued at a discount, and it's prohibited. Okay, except for sweat equity, and that part let me take you through. But before that, I'll take you to some interesting decisions here. Especially, please look at this. These are some important decisions which I want to bring it before you. Return off, especially related to allotment. Okay, I think this one decision is what we discussed just now. So this is actually a Supreme Court decision. It said that the Gopal Jalan versus Calcutta Stock Exchange, the exchange was not liable to file any return of forfeited shares under Section 75. So the current section is 39. The same was reissued, because forfeiture of shares is actually, if you are reissuing a forfeited shares, it is not allotment. It is not actually a issue. So that means that is why they use a word called reissue, because it's already issued. Okay, so it's a quite the concept itself is new. So no, you cancel the shares, it goes back again, you are issuing. No, it's not so. So there is no allotment. Okay, so that means you need not actually go for any so that PAS 3 allotment filing doesn't happen. So the process itself, reissue secretarial practice is different. Okay, normal allotment practice is different. So I will not dwell deep into the practice part of it, but I'm just highlighting the important aspect. So on forfeiture, all that happened was the right of the particular shareholder only disappeared. So instead of that, you get a new shareholder. Okay, the shares considered as a unit of issued capital continued to exist and was kept in suspense. Still another shareholder is coming and it is reissued to him. That's it. So there is no allotment, it's only reissued. So quite important twist here. So this is only this decision in 1963 is an important decision. Now I'll now take you to another interesting aspects. Especially, please look at this part. Especially if there is any defect in especially appointment of directors. Okay. So, for example, date issues and maybe in secretarial practice, certain aspects has been missed out. Okay. So then the appointment of that, because the director only will be maybe signing the share certificate, and allotment will be through by the board or by the directors will be responsible. So the allotment valid even if some defect were there in appointment order, but which was subsequently discovered. So that defect should not invalidate. But again, this decision is a very old decision, and the word that is used is called may be valid. So therefore, facts only can tell you all these aspects. So I'll not go much into the various decisions, but some of the important decisions alone I want to bring before you. Okay, I'll now take you to other important aspects, especially issue of securities. This is one interesting decision which I want to bring before you. Very, very important decision. It's an NCLAT decision and a recent decision also. Okay. Now, remedies available for preference shareholders in respect to redemption of preference shares. Because generally, if there is any issue of preference shares cannot be issued beyond 20 years. Okay, that means you can issue in the old Companies Act, the limit was originally 10, then they extended it up to 20 years. So you cannot issue beyond 20. So maybe you can have it up to 10 years also, 5 years also. So what is the message? Message is you have to redeem it. Okay, now here, please look at this. The NCLAT, especially in the matter of Bank of Baroda versus Aban Offshore, held that intention of the legislature while promulgating 55 was to compulsorily provide for redemption of preference shares by doing away with the issue of redeemable preference shares. Okay. So therefore, even though there is no specific provision stipulated through which relief can be sought for preference shareholders in case of non-redemption of company. Okay. No, the company doesn't redeem. Okay. Oh, do you have any exclusive method to? Because for an equity shareholder, see, this preference shareholder is neither equity, they are not debt. Because debt means their money is actually secured, okay, by creating a, okay, so charge. An equity, once you are allotted. But preference shareholders are, they are neither that side nor this side, okay. So unless and otherwise, and it's a redeemable preference share, RPS, okay. So that means it has to be redeemed, okay. Now, what if redemption doesn't happen? Okay. Is there any provision for them? Okay. So here they say there is only provision is they can file a petition. Okay. So like a class action suit. Now, please look at this. So alternative preference shareholders coming within the definition of members, okay, may file a petition under 245 as a class action suit being agreed by the conduct of the affairs of the company. So this is one point I will bring it before you, so that that is the only relief that is available for a preference shareholders. Okay, good. Now I'm coming for the important aspect of 62. Okay, so please look at this. 62(1)(c) is exclusively for the preferential allotment. So it is very clearly mentioned that because 62(1)(a) is for right issue. So that means for the existing shareholder, additional issue of capital. So this is actually, the section itself mentions this further issue of share capital. Okay, further issue of share capital. So naturally, it cannot be securities. Okay, so it is only share capital. So generally, if it is the further issue of securities, means it includes equity shares. The section is very clear. It's further issue of share. So that is the reason your preferential offer comes under 62. Okay, 42 is a private placement of securities, including equity shares. Okay, so here, for example, now I want to make a preferential allotment of preference shares. Okay, I want to, for a select group of, okay, I have 10 shareholders, okay, or 10 investors to whom I want to issue preference shares. Now I cannot come under 62, I'll only come under 42. Okay, so that is called private placement of securities, and the securities is preference shares. So now please come here. Now 60-1A is for the right issue. Okay. And 60-1B is for employee stock option. Okay. Not sweat equity. Okay. Sweat equity is actually customized. Employee stock option, you go by a scheme. Again, there will be one more question in that. So actually, I'm restricting my discussion only to the Companies Act. So maybe I have to go a little beyond to the accounting part, the valuation part, FEMA part. All these aspects are also there. Now, wherever you have questions, you can put forth those questions. I will take those questions also. Okay. So, friends, stock options, especially employee stock options, you have two types in it. Okay, generally two types. One, what we call it as ESOP. Okay, another is called a restricted stock unit. Okay, so generally in ESOP there will be some payment. Okay, there will be some. For example, there is a 10 rupee face value. Okay, a 10 rupee face value. 3 years later, the vesting will be done. Okay, the vesting will be done, and over a period of 1 year, you can buy the shares. So 3 years later, for next 12 months, you can make a payment of 45 rupees and buy. But today itself, the price is 30 rupees. Okay, and you are getting that particular share 3 years later at 45 rupees. And that particular point of time, the price may be even 90, 100, 150. So what if the fair market value is 150 and you have been offered at 45 rupees? So a 150 minus 45. So the difference becomes perquisite. So those are all the tax part of it. So you have the taxation part, you have the accounting part, and you have the allotment part. So the Companies Act part. So then so valuation part, tax part, accounting part, and the corporate law part. So I'll try to connect the dots, all this, but wherever you have queries, you can put forth those queries. I'll try to answer those questions at the end. Friends, there is only slight difference between RSU and employee stock option. Generally, these stock options, these ESOPs, there will be a consideration. But RSUs, there is no consideration. Okay, you are eligible. So once you cross 1 year, they will you are eligible for 100 shares. So 30, 30, 40, 30%, 30%, 40%. So 30%, that means 30 shares will be allotted, will be issued. Okay. So the price is 0. Okay. So there is 0 price. You don't pay anything. So that's why vesting date and allotment date both will be same as far as RSU is concerned. But as far as your ESOP is concerned, where you make a payment, there is a cost for allotment. So there is a price at which you will be allotted. So vesting will be maybe today, and you are given 1 year time to make the payment. So once you make the payment, so then they will allot it because they have received the money. So you have to allot it within 60 days. So maybe they will do it in the next month itself. So this is, and they'll try to recover that money also through the salary itself. So they'll say, no, you have time this much, try to make the payment. Otherwise, you will recover from your salary. So all these things are there. So ESOP concept is different. RSU concept is slightly different. Okay. So, but of course, both are stock options. Okay, both are stock options. Only the accounting part, allotment part, okay, so will be different. And of course, the tax part. Okay, so that's where the differences will come. Okay, good. And of course, once you your employer is a foreign company, you are in India, and you go abroad and then you work, you get allotted. So the implications are much further implications under FEMA, further implications under the international tax. So the subjects become more interesting and more complicated. Okay. So now come to the preferential part. Maybe this 1 or 2 examples I'll try to take and try to go a little deeper so that you understand the dimensions, okay, and the depth at which these subjects are there. Okay, so I'll just take you through maybe 60 to 1C, okay, preferential basis. Okay. Now, they have made it very clear that if it is authorized by a special resolution, either for cash or for a consideration other than cash, if the price of such shares, okay, is determined by a valuation report of a registered valuer. Now, actually, this is not there as far as right issue is concerned. So, right issue, they don't ask for a valuation report. So, of course, price is required. Okay. So, price is required and price should be explained. Why? Because you have to give an offer to the existing shareholders. So, you have to say at what price you are giving and you have to convince. Already they are present shareholders, they are owners. So, they are owners. So, they are not new persons. So, here it is for not the existing shareholder, it is for a new shareholder. And for a new shareholder, you are actually giving an offer. What you call it as a preferential offer. So for 2 shareholders, for 3 shareholders, or 1 shareholder, you are giving that particular offer. So then that share price, whatever that has been offered, should have a backing of a valuation report, and that too by a registered valuer. So that is not the case here. Especially ESOP, again, you are giving to employees. So there is no such mandatory requirement that you need a valuation here. So therefore, the price can be determined by the management. Okay. So because fair market value has to be determined by the merchant banker, because ESOP, the Income Tax Act makes it very clear. That is a rule number 3 within bracket 8. Okay. So they make it very clear that the fair market value on the allotment date, so or the vesting date, has to be determined by a merchant banker category 1. But what price you will vest, that management will decide. Okay. So because employee, because you are going to give it at a lower price. So lower price is 45 rupees, 50 rupees, 30 rupees. You decide. Management decides. Because that's a package. So generally, the package, the emoluments, the salary package is 90 lakhs. Okay. So 1.5 crore, 2 crore. So 2 crore is the CTC. Out of 2 crore, stock will be 80 lakhs and cash portion will be 1.2 lakhs, 1.2 crores. So 10 lakhs per month into 12, 1.2 crores. So balance 80 lakhs stock. And that 80 lakhs stock, they will structure in such a way, either it will be an RSU. So the entire 80 lakhs will be given as shares, or the value of the shares will be more than 80. So the difference that they have to recover. Maybe the value of the shares is 1 crore. So now that means 20 lakhs I have to recover, because I only committed 80 lakhs only, I'll give it as stock. So the balance 20 I have to recover. So then it comes under ESOP. So that is why whether it is RSU or ESOP, it's where the some of the emoluments will be open. Okay, they will not say. So you will be given a minimum of this salary, cash salary plus stock. So they don't give you a value. Okay, so they say stock value will be more. Okay, we don't know what it is. So this HR concept, the way in which they structure the package will decide whether it is an RSU or ESOP. Okay, good. Now come to another interesting aspect which I want to bring it before you, especially with respect to if it is for cash, fine. If it is for consideration other than cash, this is where we have a challenge. Okay, we have a challenge. So I will discuss this part maybe in one dimension. And I will also bring before you a sweat equity shares, because after this I'll go to sweat equity. And sweat is not ESOP. So that also I want to make it clear, because there also the same concept can come, especially for consideration other than cash. So now let me come before you some interesting aspects. Like for example, there is a allotment of shares. Okay, an allotment of shares equity. And it happens not only with private sector, it also happens with public sector. Okay, I repeat, These things also happen in public sector, especially between government companies. Okay. So private sector also it happens. So there will be joint venture. Okay. So in a joint venture, two companies, they will invest in one particular company. So they will take stakes. And both the companies, they will not invest money. They'll only invest consideration other than cash. So one will be giving maybe land, other will be giving some technology. Okay, so technology and maybe they'll say, no, you give land, we'll construct building. So the building is the consideration other than cash. So they give. For that, they will be given equity. Now the timing matters. Okay, sometimes land will be given first. Building will come. Building will be constructed 6 months later, 1 year later, 18 months later. Okay, but allotment when you have to do. So all this matters a lot. Okay, so you give the land first, it will only be in advance form. So your allotment is not done. Okay, so whether it is permitted only if you have received money for equity shares and you have not allotted. So which you have to do it within 60 days. But as far as preferential offer is concerned, okay. So whenever it is consideration other than cash, so I want to make one observation here. So point number one, if it is for a cash preferential offer, so I pay 10 lakhs, I pay 50 lakhs, and if it is 10 rupee share, maybe at the beginning, 50 lakhs divided by 10 rupees. So you have 5 lakh shares into 10. Or maybe if it is a 1 year company or a 5 year company or a 10 year company, so then face value cannot be 10. It will be somewhat 40 rupees or 50 rupees. So you have some net asset value. So what we call it as a net worth. So you have the net worth of a share. Okay. So that is your, that is called book value of a share. So book value of a share is 40 rupees or 50 rupees. So 50 lakhs divided by 50 rupees. So that means 1 lakh shares. So now the question is, it is cash. If cash is being paid for preferential offer, there is only one valuation. That is equity alone is valued. But what if you give consideration other than cash? For example, you give land as consideration. Now, if you give land as consideration, then land also has to be valued. And there is one more law that is I have not discussed about that. So, which is your Income Tax Act. Okay. So, Income Tax Act will prefer saying that no, whatever valuation you do. And the Companies Act doesn't say you have to only do valuation like this. Okay, so you can even undervalue it, overvalue it, whatever it is. Only thing is you have to get the justification from a registered valuer. So natural registered valuer will ask a question. Okay, how are you going to do it? You want to do it under DCF, you want to do it under cost method, you want to do it under market value. Okay, Income Tax Act very clearly says you are giving any asset which is consideration other than cash, okay, then it has to be valued at market price, fair market value. So fair market value as on the date of allotment. When you say allotment date, your resolution date when the allotment happens. So that means you need to do two valuation, asset valuation, share valuation. And then asset valuation divided by the share value, that will give you, per share value will give the number of shares. So quite, this is, so that means if I have to pass a resolution, okay, I need valuation report. Okay, I need two valuation report. And based on the two valuation report, I have to divide the asset value divided by the equity share value to get the number of shares. So then only I can pass a resolution. So quite very unique piece of legislation is this. So just because the word is called consideration other than cash. Okay. Sometimes it can be technology. Okay. Sometimes it can be building also. Okay. So land is first, then building. So then building, that means it will be constructed over a period of time. So you go by cost. So you need a evaluation for the building construction. So quite very, very wide. And if you look at the rules here, I'll just take you to that particular rule. So which speaks about procedures for, so this is, I think this is rule 12. I'll take you to rule 13. This is ESOP. Okay. So we have this share gap, rule 13, preferential. I was referring to that rule 13.1 only here, because in the explanation to rule 13, you have the definition of preferential offer. Okay, because the private placement explanation we saw in rule section 42. So this is in rule 13, which says that an issue of shares or other securities, okay, by a company to any select person or group of person on a preferential basis, and does not include shares or other securities offered through a public issue, right issue, ESOP, because public issue discounted because it will come under the SEBI guidelines. Right issue 60(1)(a), ESOP is 60(1)(b), okay. Or issue of a sweat equity shares or bonus or deposit is issued by a country outside India or foreign securities. So by filtering all this, it's only equity and convertibles. Okay. So preferential offer. Okay. Very straightforward. Of course, the section itself says it's only equity. So that is the rule makes it. The rule makes exceptions. That it's preferential offer cannot be used for all this. Okay. And they made one very important aspect here. Please look at this. Price at which the allotment is proposed. Okay. They made this very clear. Of course. And I'll take you to that consideration other than cash part of it. Okay. So, which also the justification. Now, please look at this. See, here they say price for which you need a registered valuer. Okay. So here they say the justification for allotment proposed to be made for consideration other than cash. So justification. Oh, it is land, it is technology, it is a server, it is some other assets. So what is the value for that? Okay. I mean, I don't use the word value. It is the price here. The justification of allotment proposed to be made for consideration other than cash, together the valuation report of the registered value. Now, this is different valuation report, because for the asset that has been offered in lieu of the equity shares. So that and this both are not same. And your accounting also will differ. So here, especially when an individual is giving, okay, sometimes people will say, no, I will give my technology to you. So for 10 years, I've been working on this formula, this particular software. I'll give it to you. You give me shares. They'll give a shares which is worth, okay, the price of the equity shares. Maybe they'll give some 50 lakh shares at 20 rupees. Okay. So 50 lakh shares at 10 itself is 5 crore. And 20 rupees means it is 10 crore. So 10 crore, so it's only he gives a technology and they give paper. But that the entire, so unless otherwise he has a cost to it. So the entire 10 crore becomes his income. So it's quite, because that's, they buy and they give. So for them, it is a cost to the company. But for the shareholder, okay, the allottee, so it becomes an income. So very critical part. So they should also understand the implication. And there is one more aspect. So you have under the income tax that once it is an income, so for the entire income, you have to deduct tax at source. So that also will come here. So quite the ramifications of this is multiplication. So it is not only corporate law. So you have corporate law, you have valuation, you have the taxation, you have the TDS implications. So one allotment, okay, one resolution will have so many ramifications. Okay. So unless and otherwise we have an answers for all this. Okay. Passing a resolution and doing the allotment will suffice. Okay. Will suffice. Now I'll just come to all the other things are the secretarial part of it. Maybe I'll come to some interesting decisions time and again I'll come for the decisions. I'll come for another aspect. Okay. So all the resolution part and all I don't want to discuss. I'll now come for maybe some bonus part, buyback also I'll come. And there has been quite uh, sea change with respect to buyback. Today, especially whenever there is a exit of shares, okay, exit of shareholders, especially. Okay. So there are two ways. So the company is actually over a period of 10 years, 20 years. 6, 7 shareholders, 10 shareholders, private limited company, they accumulated huge profits, nothing they have taken out. And one particular shareholders agreed or they don't go gel with the team. So he wants to exit. Now, one way is the share can be bought by other shareholder. So that means it becomes transfer. The other becomes, since they have an accumulated reserves and they can do a buyback. Now the point is, I mean, the old Companies Act and new Companies Act, there is a slight difference. In buyback, previously you can settle the buyback for consideration other than cash. Now it is not so. You can only buy back for cash and you have to keep it in escrow account and all this. So a lot of secretarial process involved. But buyback is only cash. So we can even call it as cash buyback. Okay. So cash buyback of shares. So I'll come to that part also later. But come to the sweat equity. This is over a period of time, recognizing the contribution by the directors or employees. Now they use this word here, very important word. Sweat equity is issue of equity to its directors. Okay. See, over a period of time, directors, they would have toiled for. Okay, so it is for past services. So that is very important. Directors, employees. Okay. Okay. So at a discount, you can give or for consideration other than cash. Okay. So for providing their know-how or making available rights in the nature of intellectual property rights or value additions by whatever name you call it. This value addition is very open. Okay. Now that means that they have given the sweat. Okay. So they have not, they are not, so for consideration other than cash, for providing their know-how, so they can give technology. Okay. Or making available rights in the nature of intellectual property rights. Okay. Or value additions. My God. Now look at this value addition is something which, because this is where the accounting, taxation, valuation, okay, secretarial company, everything will come. And packaging is very important here because, and as chartered accountants, we come across a number of clients where they toil their effort and they contribute. It is better that they are recognized for their efforts by allotment of shares. Okay, so you can say sweat equity. Of course, there are certain restrictions, 25% of the issued capital, all those, but within that you can actually do that. Okay, now look at this word value addition, which I want your esteemed attention here. Where actual or anticipated economic benefits derived or to be, okay, by the company from an expert or a professional for providing know-how or making available rights of IPR by such person to whom sweat equity is being issued, for which consideration is not paid or included in the normal remuneration under the employment in the case of an employee. So he has done some value addition. Now, what is that value addition? Okay, so it is by providing know-how. He has given his knowledge. Okay, so his efforts, his knowledge he has given. Okay, are making available rights in the nature of IPR. So he has given his formula. So his findings. Okay, so his drawings and maybe his coding. Okay, he's a software guy. So any kind of professional, engineering, okay, he has provided drawing. So providing know-how or IPR, that means you have to value this. Okay, and for that equity will be given. Okay, quite interesting. So that means this is intangible asset. Okay, know-how is intangible, IPR is intangible. Okay. So value addition is intangible. So an intangible also can be recognized and sweat can be given. Okay. And this is for the past services also. Okay. Sometimes for your past know-how services, for your past IPR making available rights, I'm giving. Sometimes it can be even an employee's like a director's remuneration, employee remuneration for the past services. So there is no know-how, there is no IPR valuation. Straight away, it is an employee cost. So the moment you say know-how or IPR, you do a valuation, you bring it as an asset. For that, you give equity. The moment that means debit will be your asset and credit will be your equity. So that means you need valuation. Okay, very similar to your previous one, which is 62(1)(c). Or it can be straight away employee benefit. So that means you debit to P&L and then credit to your equity. That's all. So that means your employee cost goes up. So this can be for the present, it can be for the past services or for the future services you are paying now, with the commitment that you will be with the company for the next, because you are already a shareholder, you will be with the company for the next 3 years or 5 years. So quite, so the sweat can be designed. Now there were, you will have interesting questions here. Now, can sweat be given only to directors? Answer is yes. Can sweat be given to employees? Yes. Okay. Can sweat be given to relatives of the employees? No. Can sweat be given to relatives of the directors? No. It's not possible. But there are interesting aspects. Sometimes the directors, relatives, they would have given some effort, they would have given some contribution in the form of, because my dad's company, my uncle's company, my aunt company, my brother's company, my sister's company. So director or employees, relatives, they would have contributed. Now, can we give sweat? No, not possible. Okay, so that is where this is. That means, can you give then preferential allotment? That is possible. So you cannot, they cannot come under the sweat category. Sweat category means they can only be directors or employees. And there can be one more question. How about a past director, past employee? Okay, now come here. The expression employee means a permanent employee who was working in India or outside India, director of the company, whole time director or not. So that means even for a part-time director also. But there was one more question. Can an independent director get sweat equity? Okay. The moment the independent director gets equity share, independence gets, okay, there is no independence. But there is a percentage. Okay, of course, under this Companies Act, they don't mention what is that percentage. But over a period of various decisions, so the substantial part, so they say beyond 2%. So 2% is something minimal. But better to not have any transactions with the company. So that is the best. So maybe if you ask, where do you find this? As per any Companies Act rules, provision, you have this. So technically it is not so. It is only 2% is a nominal. Okay. So which is by various decisions. Even SEBI, Securities and Exchange Board of India, even for a listed company, so they 2% they can hold. Okay. So but not as a sweat. Okay. So because maybe as an independent director, you can give your expertise, you can give, and you can charge for that at an arm's length. Okay. But sweat is something which only for the executive directors, okay, the working directors and employees. Okay. And there is one more. How about a past employee? The expression means permanent employee who has been working in India. Okay. Working director of a company, whether whole time an employee or director as one or two of a subsidiary in India or outside India, or a holding company above, below. Okay. So past employee is where it's not there. Okay. So given we resign. Okay. Recognize the service. Is it possible? No, you can't recognize. So it's very, very tricky. So sweat equity. But building the capital base through sweat is a good approach. And it is also another thing that if you want to save tax, you want to reduce in the form of an expenditure. Okay. So there is no cash. Technically, there is no cash. Okay. So, but it is a permitted expenditure because it's an employee benefit. So debit your P&L account, you credit your. So, but the point is this becomes an income, okay, for the employee, and TDS provisions will apply. So quite interesting part. But TDS may not apply if it is especially with respect to providing know-how. Providing know-how, you provide equity. Providing making available rights of IPR, you provide equity. So TDS will not come. So TDS is a very dicey concept there. So if it is P&L item, then taxability will be there. So if it is know-how and IPR also, taxability will be there, but TDS will not be there. That's why the multi-dimensional impact. So no, I'll directly go for issue of cert equity. So let other things they will decide. So unless and otherwise you know the impact of all these aspects, communicate to the respective stakeholders. This is what will be the impact with respect to these decisions, if at all taken. So get the consent approval and then go for the allotment. So maybe the allotment is only a secretarial part of it, but the kind of impact that it will create. So because you can pass an entry either as an employee benefit, sweat equity, take the share capital, I'm recognizing, but taxability will be there. Okay, so quite so these things travel together. Your accounting issues, tax issues travel very closely. Of course, there is another issue which I have not at all discussed here is the FEMA aspect. Maybe within the available time, maybe another 5 or 10 minutes, I will also throw light on the FEMA aspects also. Okay, so that maybe I want to discuss on the maybe only one aspect I want to discuss on this stamp duty part, especially transfer part. So just 1 or 2 aspects I'll discuss, and then I'll leave the floor for maybe 2 more points alone I'll discuss. One is the stamp duty part, the other is the FEMA part. Okay, so both I will just take 1 or 2 examples. So this is not, it is reduction and transfer. Okay, so here I want to bring to your attention the stamp duty part. Stamp duty. Now here I'll just take you to, now look at this, guys. So this is one decision I want to bring it before all of you. So a company cannot register transfer of shares unless the instrument of transfer is duly stamped. This is what duly stamped is not defined actually, and is delivered to the company. See, present shareholder and the proposed shareholder. So they have one share transfer agreement or share transfer deed or some agreement. They sign and the share certificate is exchanged, consideration is exchanged. Now this has to be registered. Okay. So then I have to give that document to the company. Okay. The expression duly stamped has to be construed with reference to 211 of the Indian Stamp Act. And this is the stamp duty rates as per the Indian Stamp Act, especially if it is equity share on delivery basis, it is 0.15%. Okay. So the document in question would be invalid if the stamp affixed there has not been cancelled. So it is affixed but not cancelled. So that is better to sign it. Okay. On top of it. So now the present 56(1), it is mandatory that the company shall not register the transfer unless the properly executed instrument of transfer. So you have an instrument duly stamped has been delivered to the company. So these are all the decisions. Okay. So we have 2 decisions here. So which is very relevant. So this is one aspect I want to bring it before you. So this duly stamped, I want to make one more observation that will you do this on face value? No, you have to do it on the price at which it has been paid. So face value is 10 rupees. So it is maybe 10 lakh shares. 10 lakhs into 10 rupees is 1 crore. but the actual price is not 10 rupees. The actual price, say 500 rupees. So 500 into then 10 lakh shares. So it's almost 50 crores. So for that only, so that is called the value of shares. The value of shares means the price at which the shares would fetch at the time of transfer, and not the face value. So again, this is also another decision. Okay. So these things matter a lot. So meaning, what if you have a properly executed instrument of transfer? You have an executed instrument of transfer. The word properly means duly stamped. The word properly will come only when it is duly stamped. Now, what if you have only a stamp, you have an agreement, not stamped? And there is one more thing, it is understamped. Okay, so that is also you have to be very careful. So that's why the value on the 0.15 percentage, you have to calculate it. So better than then take the stamp paper. Okay, appropriate stamp paper. So that will actually, or take the, they use two things. One, stamp affixed. So, or you can even take a judicial stamp paper, or so both are accepted. Okay, good. So now I'll take you to this FEMA part. Okay, maybe only one example I want to give. Okay, so maybe I'll take it here. Look at this. This is coming under the FEMA NC, I mean non NDA rules. Okay, FEMA NDA. So non-debt instrument rules. Okay. So under FEMA NDA rules, 2019. Okay. So you have an exclusive rule number 21, which is pricing guidelines. Now this can give you an idea how important the ceiling price and the floor prices. Okay. Now please look at this. If it is the price of an equity instrument of an Indian company. Now I want to give, I will give three examples. Okay. A, 2A, 2B, 2C. So I'll give three examples. Okay. Now this is now a cross-border transaction. Okay. Because maybe just I'm giving you only one example to give you how in addition to the implications under the Companies Act, you have the other multi-dimensional laws also are equally relevant. Okay. So this rule, one for your inward remittance, another is for your outward remittance. Now, whenever there is an inward remittance, there is an allotment of equity share outside India. So now I'm coming for an issue by Indian company to a person resident outside India. So that means issue of shares outside India. That means there is an inward remittance. So this is for inward remittance. Okay. And most importantly, they use the word shall not be less than. So shall not be less than. So that means so the inward remittance. Okay, whenever the funds are inward remittance, the price is floor price. Okay. Okay. So that means I will not be issuing at a price lower than this. Now it's quite a very interesting part. This floor price. Okay, shall not be less than. Okay, the floor price. Now here they use a word called, okay, so the chartered accountant can do, okay, or a merchant banker registered with SEBI can do, or a practicing cost accountant can. Look at the words, all the three can do it. Okay. Now here they made very clear that it is practicing cost accountant. But as far as chartered accountant is concerned, they have not used a word called practicing. So that means, can I presume that a member of ICAI can also do the valuation part here? Actually, the answer is no here. Why? Because Institute of Chartered Accountants have brought out one FAQ. They made it very clear that any valuation report signed by a chartered accountant should have an UDIN. Now, UDIN can be generated only by practicing chartered accountant. So, therefore, even though the rule would have missed out, our institute has ring fenced it, okay, stating that no, this is only a practicing chartered accountant. So, this is with respect to issue. Okay. Now, similarly, with respect to transfer, okay. So, this is also by a person resident in India to a person resident outside India. So, that means seller is in India, buyer is outside India. So, that means there is again inward remittance. So, again, it shall not be less than. So, the same part. Okay. So, again, inward. So, moment it is inward remittance, it is floor price, shall not be less than. But the moment it is outward remittance, okay, that is transfer by a person, transfer of shares, okay, by a person resident outside India to a person resident in India, then I will be remitting outside India. So this is actually outward remittance. Okay. So the moment it is outward remittance, it shall not exceed. So that means you cannot send more forex out. Okay. So that means it is actually a ceiling price. Okay. So you have a ceiling price here. So one, you have this floor price here, shall not be less than. So for inward remittance floor price, the moment it is outward remittance, it is ceiling price. So quite, and of course, the model Girdle and all are same. Okay, evaluation of equity instruments should be certified by chartered accountant. But actually, they use one terminology. So they don't restrict, you have to only do like this, do like this. So neither Companies Act, okay, nor FEMA, okay. Companies Act 2013, FEMA, Foreign Exchange Management Act, they don't prescribe you the method of valuation. So it is left to the valuer's discretion. So we have to apply the mind. Okay, what is the kind of company, what they do, whether it is active, inactive. Okay, so whether it is in business or whether it is an investment company. So what actually, whether it is asset based or non-asset based. So that's why they use a word called any international accepted pricing methodology. Look at this wordings. So they don't say no, this method, go by DCF, go by Navy, go by that method. This is nothing they mention. So look at the kind of I will not say complexity, but it's such a multidisciplined topic. And issue of shares and transfer of shares both may seem to be very simple. Okay, it's only allotment. Okay, I've just brought before you some finer points. So I'm not. It's not that I've restricted myself. So within the time, I have restricted to present before you the various dimensions of the subject, and I'm sure, guys, you would have got a flavor of this particular subject, especially from the Companies Act purview and also the multidisciplinary purview of this particular topic. So how significant this topic is. So one from the allotment side and the secretarial practice part. The secretarial practice depends on other aspects. So especially, are you clear with the accounting part? Are you clear with the valuation part? Are you clear with the tax part? Okay, the impact. And are you subject to TDS? Okay. So look at the various other aspects that is connected with this. So it is not that it is a standalone topic. No, I'll only deal with issue of shares. Who is the preferential the segment of shareholder from whom I will be getting the cash or consideration other than cash. So I'll only deal with the allotment part of it. No, beyond that, many aspects are there. And once the PAS 3 is filed, so it becomes a registered, it becomes a permanent document and cannot be undone. Okay. So that process gets end with the filing the return of allotment. So all this has to be ring fenced properly to get that part. So friends, so I'll maybe conclude with one small anecdote. There was a discussion between a father and a son. Okay, and the son was asking question to father. Dad, I have a doubt. Okay, what is the doubt? See, this is Kali Yuga, but in Treta Yuga, so Lord Rama listened to his father. So thereby he attained moksha. In Satya Yuga, Bhakta Prahalada didn't listen to his father. Okay, so thereby he attained moksha. So Rama listened to his father. Bhakta Prahalada didn't listen to his father. Now this is Kali Yuga. Tell me whether I should listen to you or not. Then dad said, okay, it's very good. You asked this question. I'll answer this question. So it will be in both interests. So it will be in our interest. Okay. And for the harmony of the family, that we both listen to your mother. So our mother is the book, Companies Act, rules, and all the related laws. So we'll be thorough with that. So that can actually help us to get the best out of the subject. Now we have some good questions here. So we have questions from Anil Gupta from Mumbai. Question number 1, how should companies handle renunciation of rights in practice, particularly when the shareholder base is large or scattered? Actually, rights has some value, okay, and they can actually renounce the rights for a particular price. So that your question is, how should companies handle renunciation of rights in practice, particularly when the shareholder base is large or scattered? You have to follow a process, guys. I'll give you an example. Okay, so now you have technology. So previously, maybe 15-20 years back, technology was not there. So they were using paper communication. So are you eligible? You are eligible for the rights. Are you subscribing to the right issue? Yes and no. So yes means you are using the rights. No means you are not using the rights. Are you selling your rights or renouncing your rights? So there they have to say, no, I will renounce my rights, and they have to give a declaration. Now you can have all this in the form of one portal, so that is possible today. And these facilities are now offered by various so your registrars and share transfer agents. So all this they offer it. So if it is a listed company, it becomes a mandatory part. If it is an unlisted company, the same facility can be customized for your shareholder base. Okay. How far can the board exercise its discretion in refusing transfer of shares in a private company without inviting litigation? Oh my God, actually, it's a very good question. I want to answer this question. Maybe I'll just take you to this part here, because actually they have rights. So I'll just take you to this particular question. See, especially transfer. I have this question here, transfer of shares. So since this question has come, I want to take you to some of the interesting decisions. Okay. So power on board to refuse registration. Actually, this is the power. There is a power with the board to actually refuse registration. That is there. But they have to use discretion. Okay. I just come to few case laws. Okay. Please look at this. Refusal to register share transfer on suspicion. Okay. So there is one employee to whom the share has to be transferred. Now that employee is a problem maker. Now you know that. So you don't want to register. Can you say that, no, if admitted, member will attend general meeting, create nuisance, and also obtain access? It's not a valid reason. Okay, so you have to transfer it. Okay. So mere attempts of a person to wind up a company more than once cannot be a ground for refusing to register transfer by the directors. Because they always file that application. So I will not. So these are all not ground. So they say it should be a reasonable ground. So I'll just come to other part here. Look at this. The power to refuse registration, which is conferred on the directors by the article, is a discretionary power and must be exercised reasonably, good faith, for the benefit of the company. Okay. So otherwise, these kind of court decisions, it will only be what the question put by the member is actually right. Okay. So it has to be diligently used. Okay. Especially, I'll just come to this particular decision of Bajaj Auto. Okay. So, discretion implies just and proper consideration of the proposal under the facts and circumstances. In exercise of this discretion, directors will act in paramount interest of the company. This is what I told you. Okay. Okay. And in general, shareholders' interest. Okay. Now, the court also laid down 3 tests to determine how they have to exercise. Look at, so this is the crux of his question, answer for this question. Whether they have to act in the interest of the company, have proof for it. Okay. Whether they acted in a wrong principle, and whether they acted on oblique motive or for a collateral purpose. So this background can give you a comfort. Okay. So that's a good question, Mr. Anil Gupta from Mumbai. Okay. Subrata Ghosh, Kolkata. Mr. A transfer shares of X Private Limited to Mr. B without any share certificate. Oh, and transfer deed. Is the transfer valid? Entries made in shareholder register only. Oh, how can they do it? No, if you are a company secretary, see, they very clearly mentioned there should be a duly executed share agreement or share transfer agreement. So therefore, so Mr. A transfers shares of X to B without any share certificate and transfer deed. This is company will lose because they are not supposed to do that. Okay. Then Satyananda Rautre, Cuttack. What is requirement of stamp duty on share transfer? What will happen if, if respective stamp not attached at the time of share transfer? See, then that transfer done in the register of members is not a valid transfer. Okay, so that means that transfer, that transaction, see, it is transfer of shares. The law, Companies Act recognizes, okay, you are not a owner from this date, from this date you are a owner. So that means the ownership get transferred, whether it is 100 rupees or 1000 rupees or 1 lakh or 10 lakh or 10 crore, stamp duty has to be paid. So that ownership, okay, so see, technically there is no GST. Okay, this type of what do you call instruments, financial instruments are not subject to GST. So therefore, this is the only tax, the stamp duty, okay, that gives the ownership, okay, you are the legal owner, okay. Companies Act gives you that authority. So that is why the requirement of stamp duty and stamp transfer, what do you call it as the conveyancing, okay. The conveyancing requires you to pay the stamp duty under the Indian Stamp Act. Okay. Vijayaraj Salem. So, respected sir, I am Vijay Salem. Whether issue of equity shares of producer companies, okay, that requires valuation, even issued at face value doesn't require valuation, okay, because for example, you are issuing at the initial stages, okay, so the company was incorporated maybe 1 month back. Now you are issuing. So technically there is no activity, or you have only started the activity. So now you are raising capital. So the valuation is actually face value. So no need for any valuation report. Okay. But there is this, whenever you file this PAS 3, okay, there they will ask for the valuation, because if it is the preferential allotment, because there you have to mention it very clearly. But if it is at face value, I understand, because this, whenever you fill that particular form, okay, whether at face value or at a particular price, so that, but the valuation report attachment will not be enabled. Okay, that's what I understand. Okay. So does issuing at face value will trigger 56(2) income tax at the interval of 2 different years for different shareholders? Actually, it is so. For example, okay, if it is a new company, face value you can issue. Now, if it is an existing company, and say the book value is say 40 rupees and you're issuing at 10. So that means you very clearly know book value is 10. Okay, and you're issuing at 10. Okay, book value is 40 rupees and you're issuing at 10. So 30 rupees you are giving the benefit. So definitely 56(2) will come. The taxability will automatically arise. And you are already, what do you call it, as uploaded PAS3. So it is a valid proof for the income tax department. But very careful. Prakash Kadur, Uballi, with the new notification, definition of small company has changed. Now the company eligible to obtain ISIN has changed. Therefore, the companies who are already obtained ISIN and falling under small company definition, should they surrender ISIN number and issue transfer? So you can go for DMAT and remat. Okay, not DMAT, but remat. Issue transfer transmission says, please highlight on this matter. So see now you don't want ISIN, you don't want the DMAT form. You can go for rematerialization, surrender and then go for rematerialization. That is possible. Gayatri Shah, Asansol. If the share is transferred within first year of its incorporation and the first audited financial statement will be prepared as on 31st March 2026. So in that case, how shares can be transferred? How to calculate the value per share for transfer? Okay, actually good one. So you have, so that's why, for example, it's 9 months. Okay. For 10th month, you are transferring the shares. So you can arrive at the book value itself. Okay. So not necessary, maybe you want to have the bare minimum price. See, bare minimum price, your book value. Okay. You can even go for the future cash flows, discount and all this stuff you can do. But the bare minimum price is your net asset value. So net asset value, how can you arrive at? That's your book value. So you prepare the P&L account till the previous month end before the transfer and then arrive at the balance sheet and you will get the value. So then to that extent, you can actually arrive at it. Question number 2, for a private limited company, as a practical issue, shares are transferred without share certificate. Oh my God, why? For a private limited company, we have a practical issue. Shares are transferred without share certificate. Only entries are passed to register of members and consideration. Is this legally valid? No. See, until everything goes on smooth, nobody questions it's fine. But that's not the procedure actually. So I understand that this happens in privacy. That's one thing which that's a representation we professionals and our professional body has to make. See, if it's only between the family members, small company. Okay, so all these procedures can be diluted. Okay, can be diluted and an alternative practices can be brought out. But as of now, we don't have that. So my view is we have to give that dilution. But if at all there is any legal, okay, say between brothers, between family members, one family member goes, say, no, you have not given shares, I have only paid money. So you have not allotted shares, share certificate has not been given. So until everything goes smooth, nobody will ask questions on all this. But the moment anybody raises a question on the legality part, so legally it is invalid. Okay. Only entries are passed to register of members and consideration paid. It's not correct procedure. That means secretarial practice has been taken for a task. Okay, good. Ravi Kumar Kalra, New Delhi. What is the effective date of cancellation or reduction of shares in case of capital reduction of a company? Now we have two types here. One is you go to NCLT and take a reduction. So then the court will give you the effective date. Okay. Sometimes it is reduction of capital other than NCLT, like forfeiture of shares. Okay. So then there is no need. Okay. So there are certain things which you need not go to NCLT. Okay. So then the date of forfeiture becomes your cancellation. That is your reduction of capital date. Okay. The bank DP is maintaining the DMAT account but does not inform the shareholder that the shares have been removed from the DMAT account. On inquiry, the bank is asking the client to contact the RTA to know the exact date of capital reduction. I think they have to actually know what is the Purpose of capital reduction, date of cancellation, reduction of capital in case of capital reduction. Now, what is the purpose? We have not mentioned, Mr. Kalra. So, if it is NCLT route, I need the order copy. If it is non-NCLT route, we need the board resolution. Okay, so that is the document. Samir Pradhan, Mumbai. Please clarify whether issuance of sweat equity to non-payroll third-party consultant. See, go to definition, guys. There are only two: directors, employees. Okay, non-payroll third-party consultant, they are professionals. Is permissible under Companies Act? No, not permissible. Considering they perform duties akin to employees. Agreed, but section is not. The sweat is only for directors. They are part. Okay. Even I mentioned, even independent directors cannot come under sweat because the law is silent about it. We can say how independent director, they are only a watch and ward people. So they also will not come. So my view, but law is silent. Okay. So same concept is for Mr. Samir Pradhan. Third party consultant are not eligible for sweat equity. Okay. Sai Srinivasa Raju, Hyderabad. Sir, what are the rules for materialization of shares for private limited company? I mean, rematerialization. It's not demat, no, rematerialization. Same process. You have dematted by surrendering shares. Okay. Now you have to make an application for remat and then your account will be closed. Or if you have a demat account with a 10 company, one company account alone will be debited and they will be giving you the share certificate back. Shashwat Agarwal, Kolkata. Sir, can unlisted shares of a private limited company be considered as stock in trade? Okay. Now, stock in trade means you are going to sell. Okay, buy and sell. What about provisions of section 56, 210 and 50 CA? Will it apply? See, private limited company, they are not freely transferable. You have to be very clear about it. So, that means how do you mean by stock in trade? So that means you buy, sell private limited companies. So that means it is freely transferable concept is not there. So freely transferable means immediately next day you transfer it. So maybe you become a shareholder because for a business purpose. Okay. You exit because for a business reason or personal reason. So you are not a trader there. So therefore, of course, 56.210 will apply. Okay. In what sense? Fair market value. Allotment lesser than fair market value. Transfer lesser than fair market value. So you then this 56.210 will apply. For example, fair market value is 120 rupees. Okay. And you sell it for 50 rupees. Okay. So naturally, the difference of 120 and 50, which is 70 rupees, becomes a deemed consideration. Okay, that will come under 50 CA. That is for the seller. For the buyer, 120 rupees share is available for 50. 70 becomes his income from other sources. So Shashwat Agarwal, I think the second part I have answered. First part, the section itself says it's not freely transferred. So that is what it is. Ashish Jain, Noida. What is the implication of FLAIR portal, that is your RBI, in case of shares issued by an Indian unlisted company to an overseas investor and an FDI regulation? Okay, so FDI regulation means it is inward remittance. So as inward remittance, you are now issuing shares. So issuing shares means then it is floor price. Okay, so the only point is you have to give a declaration. So there is a, what do you call it, as allotment of shares to a non-resident. So then FCGPR. Okay, so FCGPR has to be filed and you have to, the portal has to be updated. Actually, that portal updation will be done only by the authorized dealer, but we have to apply that. We have to allot the shares and inform the authorized dealer. So that's Ashish Jain's question. So hope I have covered everything. Maybe if any other question I will take up. Other else, I will hand over the session back to Seema ji.
Thank you, sir. That's all the questions we have for today's session. We thank you for the insightful and engaging session and making it so interactive with your practical explanation and response to the participants' query. And I'm very happy to also announce we are, joined by more than 1,200 participants currently are online who are viewing this session. So many thanks to you for your presence in the webinar, sir.
Thank you, madam. And on behalf of committee, on my personal behalf, I extend New Year wishes to all the 1,000+ participants across length and breadth of the country.
Thank you, sir. Thank you. On behalf of the Corporate Laws and Corporate Governance Committee, I extend our sincere appreciation to you for taking us through this practical session, and to all the participants for sparing their valuable time for this session. Thank you for being part of today's webinar. We look forward for your participation in our forthcoming events as well, sir. Many thanks to you, sir.
Thank you. Thank you all.
Thank you.